Welcome to the deep dive. Today we're really getting into the weeds on a specific strategy. How a French company might use a Luxembourg Purify, that's a Société de Participation Financière, as a holding vehicle to acquire other French businesses.
Yeah, it's a pretty sophisticated setup, and what we're discussing today is definitely tailored for you if you're, say, a lawyer working on cross-border deals, maybe a finance pro evaluating holding structures, or perhaps a director, compliance officer, or a company secretary involved in these kind of international operations.
Exactly. And for this deep dive, we're drawing heavily on a legal and strategic analysis from May 7th, 2025, which really focuses on the Luxembourg law aspects of this specific scenario.
Our aim really is to pull out the most crucial insights for you, the strategic upsides, the key legal and tax points you absolutely need to know, plus any recent updates that could impact things. We want to give you clarity without, drowning you in detail.
Right. And let's kick things off with something that often catches people's attention. The fact that a pure holding super high isn't directly supervised by Luxembourg's financial regulator, the CSSF, it sort of sounds, well, unregulated.
It does give that initial impression, but let's unpack that unregulated term immediately.
Good idea. Because it could easily sound like a free-for-all, couldn't it? What's the reality?
Well, a SOPARFI is a standard Luxembourg commercial company. It's fully taxable, and its main purpose is holding and managing financial participations shares, essentially.
Okay.
The unregulated part just means that for those core holding activities, it doesn't fall into the specific direct regulatory gaze of the CSSF, unlike, say, a bank or an investment fund manager. This can mean, slightly less administrative burden in that specific respect.
But it's definitely not operating outside the law, is it?
Absolutely not. That's the crucial distinction. While the CSSF might not be directly policing the day-to-day shareholding, the SOPARFI is firmly embedded in a robust framework. Think tax compliance, substance requirements. These are driven by big international initiatives. You've got the OECD's BEPS project tackling tax avoidance, the EU's anti-tax avoidance directives, ATAD 1 and 2.
And Luxembourg's own laws putting all that into practice.
Exactly. So unregulated is really very narrow here. It means no direct CSSF supervision for pure holding, not a lack of significant legal and tax obligations.
That makes sense. So putting aside that specific regulatory angle, what actually makes a SOPARFAI an attractive vehicle for a French company looking downstream at French targets? What are the core strategic benefits?
There are quite a few, actually. First, there's flexibility. Its main job is holding shares, yes, but it can also engage in related commercial, industrial, or financial activities. It's not just limited to shares either. It could hold assets like real estate or intellectual property, for instance.
Okay, so potentially broader than just a simple shareholding vehicle. What about the cross-border advantages?
That's a big one. Luxembourg has a huge network of double tax treaties, which is a major plus. And being an EU member state, it gives access to key EU directives. Think the parent-subsidiary directive for moving dividends around and the interest and royalties directive. These can really smooth out cross-border flows within Europe.
Let's drill down into the benefits for our specific French acquirer scenario. The analysis really emphasizes tax efficiency. How does the SOPARFAI deliver there?
Tax efficiency is definitely a major draw. The cornerstone is Luxembourg's participation exemption regime. If the conditions are met, dividends the SOPARFAI receives from its subsidiaries and capital gains it makes when selling shares in those subsidiaries can be completely exempt from corporate income tax and municipal business tax in Luxembourg.
Okay, if the conditions are met, that sounds important. What are those conditions? What does the French entity via its SOPARFAI need to satisfy?
Right, there are a few key hurdles. First, the subsidiary itself, the French target company in this case, needs to be eligible. That usually means it's covered by the EU parent subsidiary directive, or it's a fully taxable Luxembourg resident company, or it's a non-resident company that pays a corporate tax comparable to Luxembourg subsidiaries. The threshold now is effectively an 8% nominal rate or higher.
Okay, so the French targets should likely qualify on that front.
Generally, yes. Then there's the ownership requirement. The SOPARFAI needs to hold at least 10% of the subsidiary share capital. Or alternatively, that acquisition cost of the participation needs to be at least EUR 1.2 million for the dividend exemption, or EUR 6 million for the capital gains exemption.
That $6 million for capital gains is quite a high bar.
It is, but the 10% ownership test is often the easier one to meet for significant holdings. And finally, there's a holding period condition. You generally need to hold the shares for at least 12 consecutive months. If you tick all those boxes, dividends from the French subsidiary flowing up to the Lux so-parfait, are essentially tax-free in Luxembourg.
That's powerful. Now, you mentioned recent updates. Is there anything new regarding this participation exemption?
Yes, and this is quite interesting. Starting from 2025, there's a new option. The so-parfait can actually choose not to apply the participation exemption. It makes this election annually on a shareholding by shareholding basis.
Yeah, wait. Choose not to take a tax exemption. Why would you ever do that?
It sounds counterintuitive, I know,
Yeah.
but it's a strategic tax play. Let's say the so-parfait has built up some tax losses in Luxembourg from other activities or previous years.
Okay.
By electing to make the dividend income from a French subsidiary taxable in Luxembourg, it can then use those existing tax losses to offset that income. So while the income becomes technically taxable, no actual tax might be paid if the losses cover it. It gives the group more flexibility to manage its overall tax profile, use losses efficiently.
Ah, I see. That's clever. So beyond the participation exemption, what other advantages does the so-parfait bring to the table for the French acquirer?
Well, we touched on the EU directives. The parent subsidiary directive is key again here. It generally allows dividends to flow from the French subsidiaries up to the Luxembourg so-parfait, completely free of French withholding tax, assuming the conditions similar to the participation exemption ones are met.
Making the cross-border cash flow smoother.
Exactly. And Luxembourg's treaty network, especially the double tax treaty with France, is designed to prevent double taxation and can also reduce withholding taxes on other types of payments, if any were applicable.
So multiple layers of tax efficiency working together.
Precisely. Then there are the structural benefits. The so-parfait acts as a neat, centralized holding platform. The French parent can consolidate ownership of these two French targets, and maybe future ones, under one roof in a recognized European hub.
Simplifying governance and maybe treasury functions.
For sure. And having a holding company in a major financial center like Luxembourg can also boost the group's international credibility and financial standing. One last point generally, interest paid by the so-parfait on loans taken out to fund the acquisitions is deductible for Luxembourg tax purposes. There are limitations, of course, like interest limitation rules, but it's another potential benefit.
These are definitely compelling reasons. Okay, so the French company is convinced. What are the first things they need to think about when actually structuring this?
Typically, the French parent company would incorporate the Luxembourg so-parfait first. That so-parfait then becomes the direct buyer of the shares in the two French target companies, signing the share purchase agreements, or SPAs.
And how is the acquisition usually funded?
The money would typically flow from the French parent down to the so-parfait. This could be structured as an equity injection or as shareholder loans or maybe a mix of both. And as we just mentioned, the potential tax deductibility of interest on those loans in Luxembourg is often a key consideration in how the funding is structured.
Now, you flagged a recent regulatory change earlier that could impact this initial stage. What was that again?
Right, that was the new Foreign Direct Investment FDI screening mechanism in Luxembourg. It kicked in on September 1st, 2023.
FDI screening. Since the acquirer is French, an EU company, is this really relevant? Isn't FDI usually about non-EU investment?
That's the common perception, but it's more nuanced. The rules can apply even if the immediate owner, the French parent, is from the EU. It depends on the ultimate controller.
How so?
If that French parent company is itself controlled by an entity or person from outside the EU or the EEA, say a U.S. private equity firm, a UK group, an Asian conglomerate,
Okay.
then that non-EU investor is indirectly acquiring control of the Luxembourg so-parfait. And if the so-parfait, through its subsidiaries, even the French ones, engages in activities that Luxembourg deems critical, then the FDI screening process might be triggered.
Interesting. So it looks through the immediate EU parent. What counts as critical activities in Luxembourg? Is it a narrow definition?
Actually, it's pretty broad. It covers sectors like energy, transport, water, health, communications, data processing and storage, aerospace, defense, finance, media, a wide range.
Wow, okay.
So the takeaway is, even if your target assets are in France, you need to look up the ownership chain of the French acquirer. If ultimate control rests outside the EUEA and the underlying business touches on these critical sectors, you might need to make an FDI filing in Luxembourg for the acquisition of the so-parfait itself. It adds another layer of due diligence right at the start.
That's a really crucial point, easily missed. Okay, so the French entity has considered all this and decides to set up the so-parfait. What's the very first practical choice they face?
The first big decision is the legal form. In Luxembourg, the two main choices for this kind of company are the Société Anonyme, the SA, which is like a public limited company, and the Société à Responsabilité Limitée, the SARL, which is more akin to a private limited company.
SA versus SARL, we hear those a lot. What are the key differences the French parent should weigh up?
Well, the SA needs more minimum share, capital EUR 30,000, and at least a quarter of that paid up initially. And SARL only needs EUR 12,000, but it has to be fully paid up right away.
Okay, capital difference. What else?
Shareholders. An SA can have one or many, no upper limit. And SARL needs at least one, but can't have more than 100. Share transfers in an SA are usually pretty free. In an SARL, transferring shares to someone who isn't already a shareholder typically needs approval from the existing shareholders.
Makes sense for a more closely held structure.
Right. Management's different too. SIs usually have a board of directors, sometimes a two-tier structure. SARLs are simpler, managed by one or more managers. Audit requirements also differ. SIs generally need an audit if they hit certain size thresholds or are listed, while SARLs only need one if they exceed the size thresholds.
So which one is usually recommended for this scenario, a French parent setting up a holding company for French targets?
Often, the SARL is seen as more suitable, especially if it's going to be wholly owned by the French parent. It's simpler, has that lower capital requirement, and the share transfer restrictions aren't usually an issue in a wholly owned setup. It just tends to be a bit more straightforward administratively for this purpose.
But the SA is still an option.
Oh, definitely. If the long-term plan involves bringing in other investors, raising capital more broadly, or even potentially listing the holding company down the line, then setting it up as an SA from the start might make strategic sense.
Okay, let's say they've kicked the SARL for simplicity. What's the step-by-step process to actually get it incorporated?
It's a multi-stage process. You'd start with, ideally, a proper feasibility study and a business plan, just outlining the investment scope. Then, choosing a company name, you need to check it's available with the Luxembourg business registers, the LBR, and get a certificate confirming that.
Standard enough. Then the legal documents.
Yes. The critical next step is drafting the Articles of Association, the statutes. This is the company's constitution, basically. Definitely recommend getting experienced legal counsel involved here.
Absolutely. Don't want to mess up the foundations.
For sure. After that, you need to open a Luxembourg bank account and deposit the share capital, the EUR 12,000 for the SARLO. This part, well, it can sometimes cause delays. Banks have strict Know Your Customer, KYC, and anti-money laundering, AML checks.
Ah, the KYC hurdle.
Yeah. So preparing all the necessary documents for the French parent company and its ultimate beneficial owners, the UBOs, well, in advance is really key. Various bodies are trying to streamline this, but the burden on banks is still high.
So bank account open, capital deposited. What's next?
Then comes a formal incorporation deed. This must be done before a Luxembourg notary.
Yeah.
Good news here is, thanks to the digitalization law from August 2023, this can potentially be done electronically and remotely now, which is a big help.
That's a useful modernization.
Definitely. Once the deed is signed, the notary usually handles the filing with the Luxembourg Trade and Companies Register, the RCS, through the LBR's online portal. It gets published electronically too. The company then gets its official registration extract, the X-Trade RCS, which is formal proof it exists legally.
And doesn't need any kind of operating license.
Generally, no. For pure holding SOPARFI, just holding shares, a standard business license, the autorisation d'établissement isn't typically required.
Okay, quite a few steps involved. What's a realistic timeline for all this, from start to finish?
If you have all your documents ready, especially for the bank, the core process from compiling docs to notary and initial registration might take, say, 2 to 4 weeks. But realistically, considering the time needed for the client, the French parent, to gather everything, and the potential back and forth with the bank for KYC, the whole end-to-end process could easily be more like 8 to 12 weeks.
Good to manage expectations. What are the key documents they'll need to pull together? It sounds like quite a pile.
It is. For the individuals involved, directors, UBOs, maybe initial shareholders, you're looking at passports or ID cards, proof of address, like a recent utility bill, maybe a bank reference letter, a CV, a declaration about where their funds came from, and sometimes even a criminal record extract.
Okay, that's for the people. What about the French parent company itself?
For the corporate shareholder, you'll need things like its certificate of incorporation, its own articles of association, registers showing its directors and shareholders, maybe a certificate of good standing, and crucially, information identifying its UBOs often requires an ownership chart showing the structure right up to the individuals.
And for the SOPARFI itself being created?
The draft articles of association, the certificate from the bank confirming the capital deposit, the business plan, even if simple, focusing on the holding activity, and, very importantly, the UDO information ready for filing with Luxembourg's Register of Beneficial Owners, the RBE.
You mentioned updates earlier. Any recent changes affecting this documentation or registration process specifically?
Yes, a significant one, actually. Since November 12, 2024, Luxembourg requires a Luxembourg National Identification Number, an LNIN, for all individuals registered with the RCS. This includes foreign directors or managers.
So the French individuals appointed to manage the SOPAR-FI.
Exactly. If they're not Luxembourg residents, they'll need to apply for this LNIN before they can be formally registered. It's a new administrative step, so you need to factor that into the planning to avoid holding up the incorporation.
Good flag. Okay, fast forward. The SOPAR-FI is incorporated, LNIN sorted, bank account open. Now it needs to actually buy the French companies. This means negotiating and signing the share purchase agreement, the SPA. What's the specific role of the Luxembourg lawyer here?
Right, so the SPA itself, dealing with the purchase of French company shares, will almost certainly be governed by French law. That's the domain of the French lawyers.
Okay.
But the Luxembourg lawyer advising the SOPAR-FI, the buyer, has a critical role. They need to advise the SOPAR-FI's directors on its capacity and authority under Luxembourg law to actually enter into this deal and perform its obligations.
Checking the SOPAR-FI can legally do what the SPA says it will do.
Precisely. They'll review the SPA, not to give French law advice, but to spot any conflicts or issues from a Luxembourg corporate law perspective. Are there clauses that clash with the SOPAR-FI's articles? Are there Luxembourg financial assistance issues if the SOPAR-FI is involved in financing?
I see.
They'll also work closely with the French lawyers, particularly regarding due diligence findings on the targets. And they'll handle Luxembourg-specific compliance things like AML checks on the sellers, maybe coordinating that FDI filing we discussed if it's needed. They're essentially the bridge, making sure the deal works from the Luxembourg acquirer's legal standpoint.
So a tight collaboration between the French and Luxembourg legal teams sounds absolutely essential.
Crucial. The Luxembourg lawyer provides assurance to the SOPAR-FI's directors that they're acting properly within their powers under Luxembourg law when approving and signing the SPA.
When looking at these cross-border SPAs, what are some of the typical key clauses that the Luxembourg buyer needs to focus on?
Well, you've got the basics, clearly identifying the parties, the recital setting the context, and very importantly, the definitions section, getting those terms right is key. Then the core sale and purchase clause, detailing exactly what shares are being sold. In France, the actual transfer often involves a document called an ordre de mouvement.
Okay.
The purchase price clause is obviously vital, how it's calculated, whether there are adjustments based on closing accounts or if it's a fixed lockbox price, maybe an earn-out component. Conditions precedent are critical too. These are the hurdles that must be cleared before closing, like getting regulatory approvals or third-party consents.
Things that have to happen before the deal is final.
Exactly. Then you have pre-closing covenants, rules about how the sellers must run the target businesses between signing and closing. Closing mechanics detail the actual handover process. And then a huge one, representations and warranties, or R&Ws.
The seller's promises about the state of the business.
Yes, essentially statements of fact about the target companies, their finances, taxes, contracts, compliance, etc. These are especially important because French statutory law might offer a limited protection to a buyer compared to, say, common law systems. So you rely heavily on these contractual R&Ws.
And I assume sellers try to limit their exposure on those R&Ws.
Always. So you'll see clauses on limitations on sellers' liability, things like financial caps on claims, minimum claim thresholds, de minimis overall thresholds claims must exceed before payment, baskets, and time limits for bringing claims.
Right.
Indemnification clauses are also key. These are specific promises by the seller to cover specific known risks or potential liabilities, often on a euro-for-euro basis. You'll also typically find non-compete and non-solicitation clauses restricting the seller's activities post-sale, clauses specifying the governing law, likely French, and dispute resolution, arbitration is common, and various standard boilerplate clauses.
And the Luxembourg lawyer's role is to ensure the SOPAR-FI can actually meet its side of the bargain under all these clauses.
Exactly, to make sure the obligations are consistent with the SOPAR-FI's corporate powers and articles.
From the buyer's side, the SOPAR-FI's perspective, what are some negotiation best practices for these SPAs?
Number one, without a doubt, is thorough due diligence. That forms the bedrock for everything else. Then clarity in the SPA's definitions is crucial, especially for financial terms impacting price adjustments or earnouts.
Get the money terms crystal clear.
Absolutely. The warranty sought should be tailored specific to the French target companies and directly informed by what was found or not found during due diligence. For risks you do identify in due diligence, push for specific indemnities rather than just relying on general warranties. Sellers are usually less likely to cover known issues under general R&Ws.
Makes sense. Address known problems directly.
Right. Resist overly broad limitations on the seller's liability if you can. If there's an earnout payment based on future performance, structure it very carefully with objective, clear, measurable metrics to avoid disputes later.
Good point. Earnouts can be tricky.
They can. Also consider securing the seller's potential obligations, maybe through an escrow account holding part of the purchase price, a bank guarantee, or increasingly common warranty and indemnity (W&I) insurance. And finally, it's vital to lean on your French counsel to understand French market practice for SPAs. The Luxembourg board needs to understand the typical risk allocation in a French deal context to make an informed decision.
You mentioned due diligence as the bedrock. Let's talk about that. What's the scope when the Luxembourg SOPARFI is investigating the French target companies? What are they trying to achieve?
The main goals are, 1, to verify what the seller has told them. 2, identify any hidden risks or liabilities, the skeletons in the closet. 3, really understand the businesses they're buying and confirm their value. 4, get the information needed to negotiate the SPA effectively, especially the R&Ws and indemnities. And 5, plan for the integration after the deal closes.
And this is broader than the due diligence someone might do on the SOPARFI itself.
Oh yes, much broader. Due diligence on the SOPARFI would focus mainly on its corporate standing, maybe its own financing. Due diligence by the SOPARFI on the French targets covers everything: legal, financial, tax, operations, employees, environment, IT, the works. And given the current economic climate, expect this process to be pretty rigorous.
So what are those key areas the diligence team needs to dig into for the French targets?
It's a long list. Legally, they'll look at the corporate basics, the statutes, articles, the copies, registration proof, board minutes, licenses, ownership history, any litigation. Financially, they'll scrutinize the accounts, quality of earnings, net debt, internal controls, compliance with French GAAP or IFRS.
Tax is obviously huge.
Critical. They'll review corporate income tax, impôt sur les sociétés,
Yeah.
VAT, TVA, local taxes like the CET, past tax returns, any audits by the French tax authority DGFIP, transfer pricing, tax provisions, any potential exposures need to be flagged.
What about employees? France has strong labor laws, right?
Extremely important in France. Diligence covers employment contracts, collective bargaining agreements, conventions collectives, benefits, working hours, the employee representative body, Comité Social et Économique or CSE, any disputes, Social Security compliance. This area often reveals significant liabilities if not managed well.
Okay, what else?
Intellectual property and IT patents, trademarks, software licenses, data protection, GDPR, regulatory compliance specific to their industry, environmental permits and liabilities, material contracts, key customer and supplier agreements, checking for change of control clauses or termination rights. And if the target's own property, real estate diligence too. It really is comprehensive.
It sounds like it requires significant time and resources. What sort of red flags typically pop up during diligence, and how can the SPA help mitigate those risks?
Common red flags include undisclosed debts or lawsuits, messy corporate records, poor financial controls, unexpected tax liabilities, IP ownership problems, regulatory breaches, or key contracts with unfavorable terms that could be triggered by the acquisition.
And mitigation strategies.
You build the solutions into the SPA. Maybe a purchase price adjustment downwards to reflect a discovered liability. Specific indemnities where the seller explicitly covers the financial fallout from a particular identified risk. Making the closing conditional, a condition precedent on the seller fixing a specific problem first. Agreeing on post-acquisition actions the seller needs to take. Or using W&I insurance to cover potential breaches of warranties, although that usually excludes known issues found in diligence.
Right. W&I insurance won't typically cover things you already know about.
Exactly. Which is why for those known disclosed risks found during diligence, getting a specific indemnity from the seller is often the best protection, rather than relying on a general warranty that might be deemed disclosed against.
Okay, makes sense. So let's assume the deal is done. The SOPARFI owns the French companies. What are the ongoing responsibilities for the French parent in managing this Luxembourg holding company?
The work doesn't stop at closing. There are ongoing corporate secretarial duties. The SOPARFI needs a registered office in Luxembourg, often provided by a domiciliation agent. It has to hold an annual general meeting, AGM, of shareholders each year. Company records need to be maintained properly at the registered office. Any changes, directors, address, articles need to be filed with the RCS.
And who's ultimately responsible for all this?
Critically, even if you outsource tasks to service providers, the legal responsibility always rests with the directors or managers of the SOPARFI, who are typically appointed by the French parent. And tied into this is the need to maintain demonstrable economic substance in Luxembourg.
We'll come back to substance. What about financial reporting?
The SOPARFI needs proper bookkeeping, usually double entry. It must prepare annual accounts, balance sheet, P&L, notes. Even if it's a pure holding company and doesn't need the full complex Luxembourg chart of accounts, the PCN, it still needs to prepare and file these accounts with the RCS electronically via the ECDF platform.
Is there a deadline for filing?
Yes, within 7 months of the financial year end. And failure to file on time is getting more expensive. Luxembourg significantly increased the penalties for late filing of financial statements and other RCS documents effective March 2025. So timely compliance is absolutely key.
What about audits? Does a holding SOPARFA need an audit?
It depends. As we discussed, an SA is more likely to require one. And ZARL only needs a statutory audit if it crosses certain size thresholds for 2 consecutive years currently, balance sheet over EUR 4.4 million, net turnover over EUR 8.8 million, or having more than 50 employees on average. Many holding SOPARFI fall below these thresholds.
Okay. You also mentioned the Register of Beneficial Owners, the RBE. What are the ongoing duties there?
The SOPARFI has a legal duty to identify its ultimate beneficial owners, generally individuals holding over 25% ownership or control, directly or indirectly. It must keep accurate UBO information internally and file it with the central RBE.
And keep it updated.
Yes. Any change must be reported to the RBE within 1 month. Accuracy and timeliness are crucial. Again, like the RCS, penalties for late RBE filings were also increased significantly in March 2025.
Is the RBE information public?
Access was recently restricted following a European court ruling. Now it's mainly competent authorities, obliged entities like banks for their AML checks, and persons who can demonstrate a legitimate interest who can access the data. This change came in around February 2025 with the latest AML directive implementation.
Okay, transparency is still key, but access is more controlled. Now let's circle back to economic substance. This seems to be a recurring theme. What does the French parent need to ensure its SOPARFI has on an ongoing basis?
It's absolutely vital. While Luxembourg doesn't have one single substance act, having sufficient economic substance is critical to benefit from tax treaties, EU directives, and generally avoid falling foul of anti-abuse rules both in Luxembourg and potentially in France.
So what does substance look like in practice for a holding company?
It's a combination of factors. Key decision-making regarding the participations should ideally happen in Luxembourg, documented through board minutes. Having qualified personnel locally, proportionate to the activity even if it's oversight of holdings. A physical presence, like dedicated office space, is increasingly advisable beyond just a registered address at a service provider.
More than just a nameplate.
Definitely. Having an active local bank account. Following corporate governance formalities, regular board meetings held in Luxembourg discussing substantive matters. Ensuring the SOPAROF is genuinely tax resident in Luxembourg and not elsewhere. It's about demonstrating real management and control from Luxembourg.
Are there any looming changes here?
Well, the proposed EU Unshell Directive, or ATAD 3, is still out there. If enacted, it could introduce more formalized substance requirements and reporting, specifically targeting companies with limited substance that claim tax benefits. Something to watch.
And any recent court cases emphasizing this?
Yes. There was a French Court of Cassation ruling in April 2025. It dealt with French real estate held through Luxembourg entities. But the principle highlighted was the need for genuine substance in Luxembourg to claim benefits under the France-Luxembourg tax treaty. Even though that case was about real estate, the message is broader. Tax authorities are looking closely at substance for treaty access generally.
So the bottom line is, the SOPARFI can't just be a passive mailbox. It needs real activity and decision-making in Luxembourg related to its French holdings to be robust.
Exactly. To avoid challenges, genuine presence and active management are key.
Let's talk costs. Setting up and running a SOPARFI isn't free. What kind of legal fees and other expenses should the French entity budget for?
Right. Legal fees in Luxembourg aren't fixed by law. They depend on the firm, the lawyer's experience, complexity, urgency, etc. You might get fixed or capped fees for a straightforward incorporation, but M&A advice is often hourly.
Any ballpark figures for incorporation?
For a relatively simple RL incorporation, including basic articles and filings, you might see legal and notary fees combined ranging from, say, a few thousand euros up to maybe EUR 15,000, or even a bit more for complex setups. There are package deals offered too.
And the M&A advice for the actual French acquisitions?
That's additional and likely charged hourly by the Luxembourg Council for their specific role, reviewing the SPA from a Lux perspective, advising on financing, FDI checks, etc. Remember, the French legal fees for the main SPA negotiation and French due diligence will likely be a larger component of the overall deal costs.
What about notary fees specifically?
Mandatory for incorporation, usually somewhere between EUR 1,000 and EUR 3,000, depending on the capital and complexity, often includes the initial RCS filing cost.
And other administrative fees, RCS filings?
Yes, there are RCS fees for incorporation, filing annual accounts, any amendments. There's a small fee for the name availability check, a fixed registration tax on incorporation. And as we've stressed, the penalties for late filing with RCS and RBE are now much higher, making timely compliance economically important too.
Any other ongoing admin costs?
Yes, annual costs will include fees for the registered office or domiciliation agent, accounting and bookkeeping services, potentially audit fees if required, ongoing legal or tax advice as needed, bank account fees. Some estimates suggest maybe EUR 2,500 annually from year 2 for basic maintenance, but it's highly variable.
So a clear initial investment plus ongoing running costs that need careful budgeting, especially considering the penalties for non-compliance.
Absolutely. Getting detailed quotes up front is essential.
Finally, Luxembourg's legal and regulatory scene changes fast. What are the most critical updates from, say, late 2024 to early May 2025 that someone doing this kind of deal needs to know about?
Okay, rapid fire on key updates. Tax-wise, corporate income tax rate down to 16%. Net wealth tax reformed with a simplified minimum tax. That new option to opt out of the participation exemption we discussed.
Got it. Corporate and regulatory.
FDI screening mechanism is active. RBE access limited post-CJEU ruling, but UBO filing duties remain. Plus, that new LNIN requirement for individuals registered with RCS since late 2024. Big increases in late filing fees for both RCS and RBE since March 2025. The digitalization law allowing remote notarizations is helpful, and keep an eye out for the upcoming national merger control regime thresholds will be key.
Anything else?
DORA implementation for financial sector cyber resilience reflects a broader trend, and a new regulation on exchanging country-by-country reports for large M&Es was just published. It's a busy landscape.
Definitely sounds like it. Okay, to wrap this up, what are the absolute main takeaways for a French entity considering using a Luxembourg sub-RFI to acquire French companies today?
Look, the strategic logic, tax efficiency, central holding treaty access, it still holds. But the environment demands more diligence and careful management than ever.
So, key priorities.
1. Exhaustive due diligence on the French targets. 2. Building and maintaining genuine economic substance in the Luxembourg SOPARFI. This is non-negotiable. 3. Navigating the regulations, FDI, RBE. The new late filing penalties mean meticulous compliance is crucial. 4. Leveraging digitalization where possible, like for incorporation. 5. Strategically evaluate that participation exemption, opt out for tax planning. And finally, crucially, get expert Luxembourg legal and tax advice involved right from the very beginning. Don't try to cut corners here.
That's a fantastic summary. It really underscores the balance between the strategic opportunity and the increasing complexity, particularly around substance and compliance. It certainly makes you think, doesn't it, about how this global push for transparency and real economic activity will keep reshaping these structures going forward.
Absolutely. The days of purely passive letterbox holding companies are numbered, if not already over. Active management and demonstrable substance are the future.
Well, thank you for guiding us through this complex landscape today. It's been incredibly insightful. And for all of you listening, if you found this deep dive valuable for your work in law, finance, or corporate governance, please do hit that subscribe button so you don't miss our future analyses. This has been the Luxembourg Fundcast.